Right. Before the capitalism, before the modern finance system, there were a clear distinction between the right in rem, that is a property owner's right, and right in personam, creditor right. So the property owners could control their property and took a full responsibility for the use of their property. By contrast, creditors transfer the ownership of their property to the creditors, and in return for the transfer, they took interest, but didn't take any responsibility for how the borrower used their property. But in the present form of a joint stock company, enjoyed the right of debtor as well as right of creditor as well as the right of owner, while minimizing their responsibility as owner. First, they are like creditors. They transfer legal ownership to the company. So in return for the transfer, they take interest like dividend. And they do not take any legal responsibility for how the company used their invested money. For example, even though the company runs the swap shop in the third world country, they do not any legal responsibility for this kind of unethical work. It is the legal responsibility belong to the manager. But also, shareholders are the owners. They are equitable owner, but with little responsibility because they took only limited liability. So in this sense, their right is hybrid between the property owner's right and the creditor's right. But before this kind of a joint stock company, traditional collective group powers always is not blurred between the creditor's right and property owner's right. For example, family enterprise. In family enterprise, the member of family took a full responsibility. Also in commander and society, this form of collective power is very popular in the late medieval Italian city. The investor in these companies are more like creditors because the ship left the harbor for the foreign trade. So investor couldn't control how the traders traded what trader doing in the foreign country because the ship is already left the harbor. So their right is more like a creditor, not the owner. So in the post-World War decade, many critical thinkers reject principle of shareholder primacy. For example, Dodd, Burley and Means, Veblen, Tony, Lasky, Keynes, and others, they argue that shareholder is not a traditional owner, but they call is a rentier or passive owner. They took only limited liability. And they argue that the sheer size and economic power of this joint stock company led us regard this company not as a private enterprise to be run solely in the shareholders' interest, but as increasingly social and public institution. But in spite of these critics, there is no radical reform of company law regarding the director's duty and the shareholder's right. Actually, Keynes expects that big enterprise tended to socialize itself. In fact, exchange expectations seemingly sound true, because in that time, in the Bretton Woods system, the power of finance and the power of shareholders has been weakened because in the Bretton Woods system, but since the middle of the 1970s, when the new institutional finance architecture began to be shaped, things suddenly changed. The power of finance and the power of shareholders regained its strength. So the result, what we witness right now, is a finance crisis. Hybridity of modern banking. Before the modern banking, deposit transaction and loan transaction were clearly distinguished. What differentiates these two transactions is that whether there is an exchange of a present availability of goods for the future availability of goods. For example, in the loan transaction, the creditor transfer the ownership of the property and the present availability of the good to the borrower. So borrowers will take the present availability. So creditors do not have and no longer have a present availability of the good. But in deposit transaction, when depositor deposit their money to the depository, they still retain the present availability because they can withdraw at any time when they need it. But in modern banking, actually it's hybrid. First, it is a credit transaction because depositor transfer ownership to the bankers. Banker loan deposit money to the third party. So a person can loan the money to a third party only when the person has ownership of it. So ownership and present availability of the money transferred to the bank. But at the same time, practically, depositor withdraw the money at any time on demand when they need it. So present availability and ownership of the money still remain in the hand of the depositor. So it is a hybrid. So because of hybridity, there is double ownership. So there are two. So one amount of cash creates two current balance of the same amount. One is by the depositor, the other is hold of the banknote. So, two sides argue that it is my money. So, Austrian School of Economists argue that because of this double ownership scheme, there is a fundamental reason of a finance crisis. If you look at the difference between the Bank of England and the Bank of Amsterdam in the 7th century, if you look at the difference to bank, we can understand what is a hybridity means. Actually, two banks are deposit-taking bank, but deposit-taking is the way of the deposit-taking is very different. First, the Bank of Amsterdam actually take a deposit, but do not make loan this deposit to the third party. So they maintain 100% cash reserve since their foundation for the 1 and the 50 years. So their role is to clear the creditor debt relation that occurred between the merchant. So in Amsterdam, all merchants legally obliged to submit bill of exchange, their bill of exchange, to the bank. So in the bank cleared these bill of exchange using by the deposit account that the merchant made in the bank. So the bill of exchange, a credit instrument, is not a money. It is play as a means of exchange, but it's a credit. So because it is credit, it is a creditor-debtor relation. So the bank role is to clear the creditor-debtor relation. But in the case of Bank of England, they maintain only fractional reserve and make loan this deposit to the third party. So by combining deposit taking and loan making, they make a mutual indebtedness between the bank and the borrower. So bank become the debtor because of the paper money they issue to the third party is a promise, banker's promise to pay is a bank's debt. But when they issued the banknote, actually they loaned the banknote to the third party. So the holdover banknote became the debtor. So they became the two party simultaneously became the debtor. So the Bank of England is the modern banking. The modern banking actually extend creditor-debtor relation rather than clear the creditor-debtor relation. Yeah, hybridity of a financial scheme, such as mutual fund. Actually, it's open-endedness. Open-ended is a finance term, financial jargon. It means that you can redeem. If you invest your money to the mutual fund, you can redeem the money when you need it, and at any time. But usually there is a restriction. So for example, you need to wait for 6 months or 1 year. But after 6 months or 1 year, you can redeem this money when you need it. So after 6 months or one year, you can use the money when you need it. So this money constitutes your current balance. So it is your money. But because you put the money into the fund, the mutual fund, also the mutual fund loan this money to third party. So it's already third party's property. So in this sense, there is a true exclusive owner exists on the same amount of money. So because of a double ownership, it is kind of creation of money. So eventually, it contributes to the finance crisis. So what I suggest for the general reform principle to prevent the future financial crisis is to abolish this hybridity. First, in the case of corporation, the manager and worker will become the owner, and the investor became the creditor. In the case of bank, the bank's role is just clearing credit-debtor relation and the deposit taking for the safekeeping, and maintain a 100 cash reserve ratio. And in the case of mutual fund, we can abolish the open-endedness. So the mutual fund cannot no longer create money. So cannot contribute to the finance crisis. So, consequently, I argue that this principle stops the misuse of collective power. Yeah, thank you.
Okay, hi everybody. I was originally going to discuss money and its relationship to structures of exchange as described in anthropology, but I had just written a review of Capitalist Power, which will be out, I'm told, in the spring, and I was told to make some comments about that. So here's what I'm trying to do with that, and I'll try to be fast. My purposes are different from those as I understand them in Capitalist Power. One, I want to clarify the meaning of capitalist power in the context of a general theory of society. This is not something that Nitzan and Bickler are trying to do. Specifically, I have in mind Luhmann and Parsons and that tradition. And to suggest reformulation and specification of some of its main concepts, including power, capital, capitalism, capitalization. Basically, just to talk about what it means, how to define them. Two, to relate the capitalist power concept of power to the existing sociological literature on power, which hasn't yet been done, so I just want to discuss the different definitions and which ones are most applicable. And three, to begin to think about power or money. I'm not going to discuss three so much, it overlaps with a lot of what's already been said. Okay. Number one, ontological monism. Okay, so Nitzan and Bickler not only argue that states serve the interests of capital, they're advancing the much more radical thesis that states and corporations cannot and should not be distinguished in the first place. Now, that's how I interpret this, and here's a quote to back that up. My argument is that you have to be able to conceptually distinguish the two, state and capital or states and markets. In order to measure their degree of integration, they have to be possibly separate or distinct. More abstractly, you can say that to observe means to draw a distinction, or the meaning of a concept depends on the distinction used to indicate it. In order to see something, you have to distinguish between foreground and background, and so on. I like to use Gestalt images, and I like this quote from Guy E. Swanson, "Thinking without comparison is unthinkable." The references are here. G. Spencer Brown's Calculus of Indications, which was picked up later by Niklas Luhmann in his theory of self-referential systems. So essentially, concepts have opposites. To put it simply, to define a concept requires an explicit comparison or distinction. So I'm just asking the question, what are we comparing it to? I have two questions, which I'll get to in a second. So for example, if you have a concept of north as south, then you have to specify what it is you are comparing north as south to. And I think that would be a suggestion that could be made to further this research program. If you have north to south, then you could compare it to east and west. But then if you had north and south, if you conflated the distinction of latitude and longitude, then you'd be in a lot of trouble. Okay, so my first question regarding this is, from what is the capitalist mode of power distinguished? The concept of capitalist power is distinct from and implicitly compared to the concept of a feudal mode of power, at least in one point, which is fine, but this comparison is not useful for making other types of comparisons or detecting variation within the capitalist mode of power itself. So you would need to draw different distinctions, more fine-grained distinctions, or at least not with respect to studying the extent of government and corporate integration. Two, from what is the state of capital distinguished. So when they say that they are no longer separate, that may be empirically true, but in order to measure that, you have to draw the conceptual distinction. So if they are integrated, it means that they are at least possibly or conceptually distinct. So this is essentially, I'm drawing this from Parsons and others. Essentially, you have a conceptual set of categories, and then you fit your empirical categories within those. A potential problem is that if you make this argument, at least as it's the way that it's expressed, is that you could confuse a conceptual distinction with an empirical distinction. So the historically unique interdependence of private and state power does not erase the conceptual distinction between them. And another way of saying that is that you need to distinguish institutional historical actualizations from system functions. And there's a list of possible distinctions that could be made: private, public, markets, states, economy, polity, and so on. So it's at least possible to distinguish markets and states, for example, according to the type of power that they wield. Now, this is an oversimplification, and it's a conceptual rather than a concrete distinction. But it's one that's nevertheless useful. Markets can be described as using induced power. That's from Dennis's Wrong's book called Power. And states may be regarded as using coercive power. There's a whole literature on that. So to summarize, without conceptually distinguishing states and markets, empirical measurement of their degree of integration becomes impossible. So to suggest that state and corporate power have fused is to presuppose that they are conceptually different and hence possibly distinct. It presupposes, it means to say that at one time they were not, or at least they may not, it's possible for them to not be integrated. To make the argument that they are integrated presupposes their conceptual distinction, so we need to elaborate precisely what that conceptual distinction is. I mean, it's not incompatible at all with the book, it's just a suggestion. So for example, there's a lot of great empirical work in this book, and I've learned a lot from it. However, sometimes the empirical work doesn't substantiate the claims that are made. So for example, the dominant capital is operationalized as 100 most profitable firms, and there's a lot of great information provided there. It's not problematic in itself. However, one cannot infer from this finding anything about the integration of capital and state power. I'm not exactly sure how you measure the integration of capital and state power. It's pretty difficult because the data are not readily available. Skipping ahead. One possible suggestion, which I think is pretty cool, is the triple helix model, using non-parametric statistics. Basically, information theory, you take, rather than a correlation, you take three different things and see how those three different things overlap. So that might be one possible thing you can do. You might want to look into that in order to further the research program. Section 2, what is price? Price is an expression of power. 1, firms exercise monopoly power to set prices, and 2, the distribution of income between profits and wages is an outcome of power relations. I don't think either of those arguments will generate a lot of controversy or objection from most political economists. Nathan Bickler criticized Marxian and neoclassical economics alike for merely interpreting prices as nominal expressions, reflecting or distorting some objective physical magnitude rooted in the reality of material production. However, I think we need to be clear that there's a potential ambiguity in this argument. We need to distinguish capitalized goods from what I'll call consumer goods, and it's there, it's just not explicitly made. Capitalized goods like equities, like stocks and bonds, are priced according to their expected future values, whereas non-capitalized goods or consumer goods are set by dominant firms with monopoly power, which begin with a long-term target rate of profit and then calculate the markup necessary to realize this rate of return over the long haul. So in short, the price of a consumer good is whatever sellers want it to be, whereas the price of a capitalized asset is, for example, the weighted average of whatever speculators expect it to be. The implication of that, however, is that a theory of asset prices is not a general theory of price determination. Different commodities may have their prices determined in various ways, so we need to be cognizant of that. 2, prices therefore reflect power in at least 2 different ways, neither of which is consonant with the confidence and obedience frame or definition, which I'll describe next. And 3, capitalist power approach, I think, might be susceptible to the same criticisms made against Marxian value theory, specifically the temporal single system interpretation of Kleiman. In this sense, it can only account for prices ex post by interpreting prices as quanta of social power in the same way that the TSSI interprets prices as quanta of value after the fact. So what is power? I think we need to define what power is. And I haven't heard anyone define power today, so I'm just going to give you a bunch of definitions of power and then give you my favorite. So the one here is that power expresses the certainty of the rulers and the submissiveness of the ruled. I like this phrase, confidence and obedience. It's poetic. And here's some different below are some different explanations of that. However, there's again a disjunction between the data and the qualitative description of that data. So, number one, to say that the power of capital is confidence in obedience, I think misconstrues our ordinary understanding of what obedience is. So capital neither commands nor obeys in itself. Obedience implies a command, injunction, or order to obey. So to command and to obey are transitive verbs, which means that they are orders given directly from some specific persons to some specific others. Societies, in the sense of Marxian, collective self-domination, alienation, social conditions are the unintended consequences of individual intended actions. We are influenced or subjected to these types of social systems, but we don't receive orders from them directly. So a suggestion would be to use Russell's definition, which is later refined by people like Wrong. It's a simple definition. Power means the ability to produce intended effects. It's intentional influence, as opposed to unintentional influence. It's organized as opposed to self-organized. And we can subdivide this into two dimensions: power to achieve goals, power over others. Two, is the concentration we observe caused by intended or unintended influence? That would be the big question. Now, the main thing that isn't addressed is that the power law distributions that we observe, which characterize the distribution of wealth, income, and even natural objects like rivers and tributaries, it's possible for them to result from the rules of the game, so to speak. They can be self-organized. There can be policies in place. They can be unintended consequences of individual actions or Giddens structuration and so on. So one suggestion would be to use agent-based models and simulations. What you would do is that you would use an actual simulation and then observe how much inequality arises from the simulation. An agent-based model is, they're also called artificial societies. They're also called computational approaches. And what you do is you program certain rules, and then individual agents interact with one another, and then you see the pattern that arises. So you would want to compare what actually has happened with some simulation, because you would never actually expect to explain all the R squared. You would want to, by nature, some things are just stochastic and not really totally. How much time do I got? Right. Okay, so here's some power concepts. We can go through that.
Maybe 10 minutes.
10 minutes? Okay. Power is the capacity to intentionally influence others. Bertrand Russell, and then Max Weber, and then Wrong, some others. There's lots of different definitions of power, and I think it would help bridge the divide between economists and sociologists if these relationships were made more explicit, because there's a whole body of literature out there that really isn't bridged, and I realize you can't do that in one book. You have to be several, maybe a volume. Here's one map of power. There's influence, there's intended influence, which is defined as power, and there's various other possible ways of categorizing power. But we want to be clear on what we mean by power. Okay, part two. So part of my research right now is actually developing an agent-based model of status hierarchies and showing the relationship between that and debt. But I didn't bring that here today, so I'm going to talk about money. So we can talk about money as credit. That is a means of mobilizing human and natural resources. Credit denotes one end of a credit-debt relationship, and thus expresses and exercises the power to mobilize resources by virtue of its command over the obliged. The monetary relation of credit and obligation is the prevailing form of power in capitalism today, supplanting but not entirely replacing relationships of command and obedience. And by command and obedience, what you have in mind here is Stanley Milgram's famous study, Obedience, or the concept of Erschaft. Sorry if I'm mispronouncing that. Command, think of the military giving orders. We do see the patterns, but it's clearly not a result of people giving orders. So, as talked about by several presenters, Randall Ray, who I've been reading, others. Money can be defined as social relationships, so you can just think of it as an obligation, or as the object used to symbolize a social relationship. This is the relationship or the thing used to symbolize the relationship, and so the latter is necessarily subordinate to the former. What's more important is the unit of account, and so on, that was discussed earlier. You can think of money as credit. Credit is the end of a debit-credit relationship, which is a form of power. We're talking about codified monetary obligations, which distinguish some obligations from others. So we have quantified obligations, quantified in various ways, and a debt is specifically a legal obligation as opposed to, say, a liability, which there's no legal obligation to pay a liability, but there is for a debt. So we already see a connection here between the state on the one hand and the economy on the other. So let's go through some of this. I'm just going to rephrase and state a little differently what some of the arguments that have come before. So we can regard credit as a political power relationship, and this isn't new in the sociological literature. Parsons and Smelser talked about the creation of credit as primarily an exercise of power, and not an economic form of influence. And so they regarded credit as specifically a form of, as being in the domain of politics or the polity. Now, money is a credit. That's fine. We can understand that. But then, specifically, who is the creditor and who is the debtor? So Keynes, Irving Fisher, a lot of other people distinguished public or state money from private or bank money. We can regard public money as credit issued by a state and collected as taxes. You can think of the taxpayers as the debtors, whereas private bank money is credit issued by private banks. Now today these have become indistinguishable. They've been fused, as people like Ingham and a lot of others have stated. Most or all state-authorized currencies issued by private banks is private money. So my argument here, and this is I was going to ask a question, but I didn't get called, that is regarding the political implications of this idea. So what policies would be implemented if this were true, which it is. So the difference between them, between public money on the one hand and private money on the other, depends on the structures of exchange which are induced. It depends on the specific tax policies, for example, that are implemented. In anthropology, we talk about bilateral dyadic exchange structures as opposed to generalized indirect exchange structures. The latter, generalized exchange structures, look like that. And this is called net generalized exchange as opposed to generalized exchange. Generalized exchange would be like a circle, paying it forward. A pays B, B pays C, C pays A. Net generalized exchange looks a little different. It looks like this, where A collective is, B and C collectively owe A. A gives money to B and C, or B or C, and then A uses up his credit, and then the money goes to C, and then C's got some money, so A and B are indebted to C. People like Nobel laureate in chemistry Frederick Soddy had this concept of money. And really what you have in mind here is a sort of equilibrium where the money is passing from one person to another. But in fact, that's not actually what we see. That would be great if money were that. But that's distinguishing money from material wealth. That makes money not dependent on the expected value of assets, which it is today. This is basically an ideal model of state money or public money, and it pertains to a specific anthropologically specified structure of exchange. So specifically in the U.S., the Federal Reserve prints Federal Reserve notes, which function as legal tender or fiat currency. It's different from country to country. But in the U.S., and everywhere, it's mostly private bank money. But specifically in the U.S., it's interesting that... I was going to go into this. 1 minute? Okay. Let me just... this is Let me give you some data on who holds U.S. Treasury securities. Specifically regarding public debt. Public debt shouldn't matter. For one, we're mostly indebted. Most of the debt is domestically owned, which means you can tax people to get the money. Okay. Second of all, there's no reason why the Treasury should be borrowing from the Federal Reserve anyway. One question that it had was regarding the policy set forth by Dennis Kucinich, which is based on narrow banking or 100% reserves, would have effectively nationalized the Treasury in the United States, or nationalized the Federal Reserve, sorry, in the United States, integrating it with the Treasury. But then in addition to that, it would have outlawed fractional reserve banking, which means that the state would have the power to spend money directly into existence rather than having money or credit or power being loaned bilaterally by private bank interests. So if you see the holders of U.S. Treasury securities here, by 2010, the foreign composition, foreign meaning this is for the United States, goes up. But look at the Federal Reserve has about 11% of that, which is crazy. So the Federal Reserve is like creating the money, which the Treasury then borrows. So right now, the Treasury, whatever it doesn't collect in taxes, has to borrow. But that's just a legal convention. The Treasury could just spend the money, could create the money itself. There's no reason why that's not possible. So this whole crisis is fabricated, but nevertheless real. Okay, so I'll stop there. Thank you.
Okay, I'd like to invite questions and comments from the floor at this point.
Yes, I don't like usually to jump first, but this is begging, really. I think that I have the advantage of actually having read your reviews, where I think the other people in the audience haven't. So it's important that I give my take of it. Initially, I thought that I will correspond with you and maybe both of us, Shimshon and myself, and maybe have an exchange, but very quickly we realized that we're not going to have it. And the reason is that your reading of our book is at best a collection of misunderstandings. And at worst, I think that you're reading in a book whatever you want to read rather than what we write. And I'd like to give a few examples. For instance, you conflate back and forth the concept of the market, the corporation, and capital, and you exchange between them. You do similarly with state and government. We make a very clear claim that under the capitalist mode of power, the state of capital encompasses within it both governmental and corporate entities. We are not saying that, say, the state and the corporation is the same thing. But you liberally attribute to us all sorts of claims that we actually never make. A second example, you argue that there's a difference between capitalized prices and consumer prices, that consumer prices are not capitalized. Well, of course they are capitalized. Any product on the market can be sold this period, the next period, the period after. So if it's sold this period, it's discounted for one period with a rate of discount of 1. If it's sold next period, it will incorporate in it the discount rate, the risk that is not going to be sold, etc. You argue, for example, that market prices have no embodiment of power. They're not reflecting power because they're not set by corporations. So what? I mean, you look at the price of oil, which is ostensibly set by the market, or the price of grain. We're going to see Joe speaking about grain prices. And certainly they involve institutions of power that can be clearly articulated. Again, you're attributing to us claims that we never make. Thirdly, you argue that our claim about prices can be likened to the claim of Marxists, that prices can be understood only ex post. Well, that's exactly what we are saying, but that is not what the Marxists are saying. The Marxists are saying that prices, the quantities in the nominal world, are a reflection of real and objective quantities in the material world, and they never deliver. We never make this claim in the first place. Now, finally, I want to say, and it will take about a few minutes to articulate that, you give a very long list of all sorts of power definitions, and you just basically pick and choose the one you like the most, and that should be satisfactory in your opinion. Now, I'd like to say something about the history of power that perhaps very few people are aware of. In fact, the concept of force and the concept of power, especially how we understand them in cosmology, have a very long history. There are, in fact, three major periods. The first pre-scientific or semi-scientific period, up until the year 1600, is marked by two properties. First, force is considered to be an entity in its own right. So if you take an object, or if you take a property such as heat, then you can put next to them the entity called force. So force is an entity in its own right. Secondly, force is treated qualitatively. Nobody has ever tried until the year 1600 to quantify force. So that's the first period, the pre-scientific period, the semi-scientific period. The scientific period of mechanical understanding of the cosmos begins with Kepler, really. And Kepler is the first one to say force is not an entity in its own right, it's a relationship between entities. And secondly, he's the first one to come and say force is a quantitative thing. We can understand it quantitatively, and that's what we should do, and he actually does it. Newton comes next, and Newton basically said force is the glue that actually makes the reality possible. It's the thing that connects everything together. And the last stage of this mechanical picture is the theories of dynamism that come with Ernst Mach, with Kirchhoff, and with that come with Leibniz, with Kant, and with Boscovich, that argue that actually force is not the glue that connects things in reality. Force is the very elementary particle that makes reality possible in the first place. And I think that our understanding is very close to the ideas of Boscovich on that remark. Now, finally, we have the last stage in the treatment of force that comes with people such as Ernst Mach, Kirchhoff, and Hertz, in which physics moves away from force because force is understood as a metaphysical entity that has nothing to do with physics. So nowadays, in theoretical physics, force actually is expunged from theoretical physics. It doesn't exist as an entity. It's a heuristical device. It's a mathematical device, but it doesn't have any existence. Now, in my opinion, most of the theories of force in the social sciences, yourself included, belong to the pre-scientific or semi-scientific stage, in which force is an entity. It's like a battery. This is Bernard Russell's notion that basically you have force and then you allocate it as if you have some sort of a charge. And it's not quantifiable. So because a mother has ultimate power over a child, she has probably more force than the US government that does not have ultimate power over its subjects. And it cannot be comparable because it's not quantifiable. This is the state in which most social theories deal with power. We are moving, I think, to the edge of the mechanical worldview in which power is actually what makes reality in the first place. So I think that there is a huge divide between the critique that you offer of power and your own concept of power that has absolutely no universal principle to compare different powers. I know that this is pretty forceful, but I think that the arguments that you suggested as a critique of our book are so wrong-headed that I had to clarify, at least for the audience. Thank you.
Okay, thank you for that, Jonathan. If we could have Randall next, Professor Randall Ray.
Okay, two comments. First on the foreign-held U.S. treasuries, because that came up twice today. Actually, if you look over time and if you plot foreign holdings of U.S. treasuries and the U.S. current account deficit, they match. And the reason is because we pay for imports by issuing dollars that are held by foreign, mostly central banks, which are reserves at the Fed, and they say, hey, rather than earning zero, we would like to earn a positive return. and therefore they buy treasuries. So that's how they get there. Of course, we never borrow from Chinese. That would be crazy, because we are the issuers of the dollar. We actually can't even borrow dollars from Chinese. We create the dollars that the Chinese hold, and then we let them earn interest by moving from what's essentially a checking account at the Fed, we call it reserves, to a savings account at the Fed, we call it U.S. Treasuries. It doesn't give the Chinese any power over us whatsoever, except to the extent that our policymakers don't understand this. And they don't. And they don't. And then the other comment is on the Austrian view of banks. It's just completely confused. As Minsky always said, banks don't lend. Money lenders lend. If you want to borrow money from a lender, you go to a street corner in Chicago, and there are money lenders there, and they lend. Okay, they actually will give you cash. What banks do is they accept. They don't lend. They accept. They accept your IOU, and then they issue their own IOU. They never lend money. You can never go to a bank with a wheelbarrow and say, hey, I would like to borrow $100,000. They don't do that. What they do is they credit your bank account. That's all. They substitute their IOU for your IOU. They accept yours and they issue their own. And so all the Austrian proposal, well, their explanation of the crisis is slightly on the right track, but their reforms are all completely wrong because they don't understand what banking is all about. They're not lenders.
Okay, do we have any more questions or comments out there? Okay. Did you have a question? Yeah. You want to make an answer? No, I think we'll just answer those questions then. John,
I'll go first. Thank you for those comments. I wish we could have had this exchange earlier via email. I remember I sent you a draft when the paper was in its infancy. I'll just say a couple things. Regarding power, I was talking about your definition of competence and obedience. Obedience is an old concept which has a history, and it's related to people assume that there's a meaning behind that. I'm not saying that you're wrong. I'm saying that there's better ways to describe the data that you're using. I think that's a poetic moment in your writing, which has its own value. I'm saying that we can describe that differently. Let me say also that I think our purposes are orthogonal. I think we're cross purposes, and that's okay. I think that's fine. As I said, I'm interested in talking about your theory, contextualizing power, which is not what I understand was the purpose of capital as power, contextualizing it in terms of a general theory of society. And regarding the TSSI and Marx, my argument was that to the extent that your argument was, to the extent that you were saying that TSSI, or value theory in general, wasn't able to, let me put it this way. Yeah, I get it that the value is determined by the expenditure of socially necessary labor time, and that the past is, according to this model, is producing. It's like determining values in sort of a linear, it's going from the past to the present. It's not based on expectations, it's not ex post. And that your model differs from that. What I understood one of the criticisms of the TSSI was that the TSSI actually, by definition, equates, this is one of Marx's three equalities. Don't ask me the other two, I can't remember right now, but where total money equals total, what is the value? Total money equals total value. So if you get, so in the TSSI, it's basically you get lots of different prices, but the distribution itself is not actually predicted or determined. That is ex post. And to the extent that you were saying that was insufficient, that would also apply to the capital to power approach. But then at that point, you just get two theories that are consistent, and then you'd have to evaluate those theories on other grounds. That's all I was saying, but that's not even that important of an argument. Regarding the rest, I'll just leave it up to, maybe we can continue this later, but thank you.
Jongchul, do you have any comments regarding Randall Ray's?
Frankly, I don't understand what does it mean by bank cannot loan, do not loan, make loan to the third party. Yeah.
Let me try to explain. Even in the picture where you have the depositors of the banks deposit money, the banks lend it out, and then the depositors want to get it back. It's not the way banks work. The way that a bank works is you go in, you have a project, you want to buy a car, you want to buy a house, whatever it is, the bank accepts your IOU and it creates an IOU. And that IOU we call a deposit. So this vision that people bring in wheelbarrows full of cash and fill the banks full of cash and then they lend it out is just, it's definitely not a description of the way banks operate now. I think it's also fiction. I don't think they operated that way in the past. But anyway, they don't operate that way now. Okay? So they issue an IOU. Now, they're called a demand deposit because on demand, whoever ends up with that demand deposit is able to demand redemption. They can make a withdrawal of cash. Banks don't need any reserves whatsoever to meet that withdrawal. And in fact, in Canada, they don't have reserves anymore. There is no reserve requirement. But on demand, the Bank of Canada stands ready to supply banks with reserves as they need them to meet withdrawals. So 0% reserve requirement. System operates perfectly well. Any one of you can go get cash out of your ATM machine, and the Bank of Canada will ship the cash to the banks to meet any withdrawals. Now, that doesn't mean I'm opposed to the proposal of creating new kinds of banks, like postal savings banks, that don't make loans in the correct sense of the term, that is, accept liabilities, that hold only, let's say, treasuries, and issue only insured deposits. Okay, that could be a reasonable proposal. Would it have prevented the crisis? No, not at all, because you have financial institutions all over the map that are issuing highly liquid liabilities, including the money market mutual funds, that the issuers like to pretend are as good as cash, and they were until there was a run on them. So creating a system of 100% banks is not going to prevent other financial institutions from issuing liabilities that in good times are as good as cash. And when, the crap hits the fan, the government bails them out, and therefore everyone says, oh, well, actually they are as good as cash. So we had a run on money market mutual funds in the past crisis. That's $3 trillion. Total insured deposits in the U.S. is only $6 trillion. So half the size of insured deposits with no guarantee at all, although the Treasury bailed them out. Dodd-Frank makes it illegal for the Treasury to bail them out the next time. But there's still $3 trillion there. And they hold mostly European bank debt as their assets. So the run probably will start there.
Do we have any other comments or questions?
Yes, I have a question to Stefano. I'm not sure that we got the gist of your presentation, but if I did get it, I'd like to understand something. You argue that your discussion about Ramsey's preference structure and social welfare makes assumptions. It makes an assumption that the object that we are trying to maximize is somehow measurable, utility, that this object can actually be aggregated across society in some fashion, or comparable across society in some fashion. And it also makes the assumption that it's relevant in the first place in a society in which I would argue preferences are to a large extent superimposed on most people. So I'm just wondering, what is the relevance of this entire discussion in general for our world, and how is it related in any way to the discussion of power that we have here?
Stefano, if you'd like to respond.
Well, maybe it is not related at all, but my point was this is a body of what is called mainstream economics. And as you said, there are very strong presuppositions like measurability, like making comparisons, and also preferences. A good question would be, where does power come in this Ramsey argument? What I was interested in was the fact that, first of all, Ramsey has to make normative assumptions, which show that there is a tension between this betterness relation, which is undoubtedly a foundation of Ramsey's discourse, and the problem of representing this betterness relation in terms of expected utility functions. And secondly, in the paper about probabilities, Ramsey shows solutions of this problem, bridging the gap between ethical arguments and economical considerations, also using mathematical devices. Which show that he is using what Rohit Parikh, a computer scientist, calls algorithmic devices or social programs. And well, as to power. If one asks, where does power shows up in economic analysis? So it is either captured as an index problem, something which comes from the outside, or as some category of goods, like positional goods, so something which has to be axiomatized and has to be introduced in the system. So that's why it was very interesting for me to see and maybe Ramsey eliminability is also known. So you can eliminate utility from social sciences, from economics, but you cannot fully eliminate physical entities from physical theories. So either we produce economics which performs more economics, or we try to operate with the given categories, and we display the same kind of inventiveness and theoretical fantasy which Ramsey shows in this paper and also in his other contributions. There are two contributions on economics. So I think power is not in Ramsey's paper, but Ramsey shows how to bring in power, and not in the fashion which has been suggested by other scientists who tried to reconstruct and to interpret Ramsey's model.
Okay, thank you, Stefano. Any other questions? We've only got a few minutes left, so I'll ask you to keep it brief if there are any. Okay. I think Joe had an announcement to make.
Thank you, guys. Thanks for being here today. I've made a reservation at a French bistro at 8:30. It's located downtown. The reservation was made for 20 people. There's around 20 people here, so if you want to come down with us, you're welcome.